Thanks for having me. It's beautiful, Vienna. I love being here. You guys have amazing buildings. This is such a nicer building than anything that we would be in if we were in, say, Schaumburg, Illinois, or Salt Lake City, Utah. This is amazing. And you don't even realize how beautiful it is until you've left and you live somewhere else for a while. I really have enjoyed the presentation so far. I was listening to you talking this morning about climate, and I couldn't help but think about Florida. Because it's, what is it now? I've got two watches on. Oh, this is the one that I'm supposed to use to keep time. It's April 19th, and the June 1st renewals are coming up in Florida, and there's this huge debate between reinsurers and buyers about whether rates should go up or down. But it's true. 30, 40, 50 years ago, Florida, it was just all like the Everglades, except for Miami. It was all just a big swamp with alligators and guys in pickup trucks. And so if they had a hurricane, it was, especially on the West Coast, the damages were far less, and throw in climate change and everything else, and it's a big mess. And obviously the public-private partnership debate is front and center in Florida. I'll never forget, after Hurricane Katrina, how upset Floridians were with people in Monte Carlo when they were drinking champagne, the reinsurers, and popping corks, when people in Florida were having to pay more for cover on their houses. That was a bad, bad thing to do. And that's one of the impetuses for the Florida Hurricane Catastrophe Fund, one of the great public-private partnerships in the world, actually. But that exists because we didn't really quite understand the political implications of insurance. And so it's really important to get both sides. Anyway, sorry to digress. I'm here today to talk about cyber. And it's true, cyber is terrifying, especially if you're an insurer and your clients are asking you to write it. Michael is right. It can be incredibly damaging to a small company that doesn't understand it. In fact, a few years ago, I was on a panel with James Slaughter from Liberty Mutual, and I don't think he'll mind me saying that he just said, nobody should write this. We don't understand it. And if you write this, eventually you're just going to lose a ton of money. It's true. Most of the people who are perpetrating the cyber hacks, I should say, the average age of these people is probably 15 or 20 years younger. No offense, everybody, but to the average age in this room, because not everybody, obviously. There's a standard deviation, but truly, it's very young people who are highly intelligent, many of them on the spectrum, and they can hack through anything. And if you go on different websites and look at just records, for example, the Center for Strategic and International Studies, if you just go through all the hacks that take place every single week, they're happening all the time. Russian hacking group linked to disrupting the Pyeongchang Olympics, targeted individuals in France, Germany, Switzerland, Russia, the Ukraine, linked to biochemical threat confidence organized by companies. Next, Chinese hackers engaging in cyber espionage campaigns to collect data from satellite and telecom defense organizations in the US and Southeast Asia. Next, Ukraine police claim that Russian hackers have been systematically targeting Ukrainian banks, energy companies. Next, marketing data from Exactus. This is every day, happening all the time. It's happening right now. And so this is an ongoing risk that's happening. People are attacking us all the time. I now no longer go on the internet unless I VPN through an encrypted server elsewhere. I won't go on the internet and do personal searches because I know there are people that can see everything I'm doing and who can target me. So anyway, just to get everybody good and worried before I start, I'm going to talk about first evaluating cyber risk, and then and I think Michael already talked about the evolving state of cyber cover. We'll talk through that a little bit, and then we're going to talk about, since we're in Vienna, how the sausage gets made, the response, unlocking the potential and creating the right modeling and the right. I had Vienna sausage, it's not American. I had Vienna sausages this morning. They were delicious with mustard and everything. I did for breakfast. Unlocking the brunch, unlocking the potential of cyber market. So. Cyber risk, it can happen anywhere. Has anyone seen Mr. Robot, the TV series? Oh, come on. You have to. You have Mr. Robot? Nobody's watched Mr. Robot? Watch Mr. Robot. It has Rami Malek and Christian Slater, and it's about a young hacker who tries to eliminate all the biggest credit bureau in the world, to eliminate all debt. Anyway, it's really eye-opening. Cyber attacks can happen anywhere. They can happen online or offline. You can have malicious cyber attacks, or just stupid employees who have, like me, who do dumb things like open attachments that they shouldn't. It can be somebody internal to your company or external. I know I'm stating the obvious, and it can happen, technology firms, media firms, data firms, government firms, and of course, insurance companies and their clients. Good heavens, this is a busy slide, but I'm going to go through it quickly. You have to be able to identify and have a framework for the types of threats. And so, folks, I'm starting here at 50,000 feet or 18,000 meters or however you measure it. But you can have human actors, waves, targeted games of cat and mouse. There can be collaboration. There can be teams of hackers, particularly coming out of Russia and China. I'm sorry to say it, if I have any Russians or Chinese here. You guys increasingly have teams of hackers doing very specific things, going after companies, going after public-private partnerships, government institutions. There are different types of attack types. We've all heard about social engineering, right? The 2016, it's a bit ridiculous, but it's true. The 2016 elections, you definitely have government cyber actors trying to swing things one way or the other politically. That happens. Ransomware, obviously the big NHS virus, well, we call it the NHS virus because the NHS of England is one of the only, institutions in the world that has software that's not so sophisticated so that those types of attacks got through. And so they were hurt more than others. I'm talking about the WannaCry virus, if you didn't remember it. Denial of service attacks, right? Cryptojacking, malware, and there can be all kinds of targets. It can be a non-targeted splattergun approach. People go after retailers, financial institutions, healthcare providers like the NHS, service providers. There's been an uptick in attacks on cloud services, another reason why I use VPN, because I store a lot of my data in the cloud, and if some young kid in Russia who's smart enough wants to get access to my IP address, it's not going to be a problem. And then bang, he or she has all of my data, all the pictures, every file that I've ever had. So use encrypted VPN, folks. It's worth the money. There's also small businesses, and this is one of the greatest areas of growth that we've had in the cyber market, particularly in the US binders market. Weirdly enough, we've had a lot of smaller businesses buying cyber. That's a particular area of uptake, but not just small businesses. I could talk through all this stuff. There's regulations happening in Lloyd's, the PRA, AM Best, the GDPR. Has that actually solved any problems, folks, the GDPR? No, it's just created more admin. They're laughing at us. The hackers are laughing at the regulators because the regulators are all 50. They're like me. They're 45-year-old guys, and the hackers are 20. And they're smarter than us, and they're just going to get around it. I'm sorry. So the GDPR regulations, California has its own regulations, Singapore, it's a hodgepodge, and then there's growth. From its, as Michael was pointing out, the historic birth of cyber was in the E&O lines. So there is a liability language to it, but it's now going into other types of physical damage, bodily injury. Don't forget terror. There's cyber terror. And, we're going to talk all about responses later on. I better get going, though, because we have to hurry. There's a lot to get through. This is just showing you different types of examples that can happen. And actually, JLT, now Guy Carpenter, right? We published a report last year, 2 years ago, about cyber, where we talked through all these different scenarios. But this just shows you phishing, zero-day vulnerability attacks, denial of service attacks, and how they can all actually work in all these different ways. Ransomware, power grid outage. We can, air traffic control towers. I'm going on an airplane after this. So they can attack anything, almost anything with cyber. Because the world is becoming much more interconnected. We all talk about self-driving cars. We talk about all these different technologies, artificial intelligence, automation, right? Everything is going to really be run by technology. Well, what's the outcome? We're going to be more exposed to cyber risk, no doubt about it. This is a deep dive on one particular scenario. I am not going to torture you by reading through this entire slide. You're welcome. This is ransomware. So this is just one type of cyber attack. It is very similar. You'll see a lot of familiarity here. Those of you who are familiar with the WannaCry virus that had such a particularly bad effect on the NHS. Sorry to keep waving at the Brit. Like, sorry, the NHS sorry, it's not just the NHS, but this kind of walks you through the different scenarios for ransomware, of which WannaCry was one. I'm going to leave it to you to read through this in the presentation afterwards, okay? Because this probably should have been in the appendix anyway. Okay, so that is sort of defining the problem. Anybody have any questions about cyber? Anybody have any doubt about cyber and what a huge and growing risk it is? I'm so afraid of it that I pay to encrypt all my internet activity. So it's worth it. All right. The reason I do that is because I had this guy come in and he basically said, you want to see all your stuff that's on the dark web? And he was a cyber expert who was working for a security firm in London. And he pulled up me on the dark web. I'm just a random person. I don't do anything particularly naughty. And anyway, he pulled me and my IP address up on the dark web, and it just blew my mind how much information was out in the public about me, little old me. So that's why I started encrypting everything and VPNing in through a server in Estonia or Canada or somewhere besides London. All right, so the evolving state of cyber cover. What's happening? Is it worth writing this stuff? Does anybody feel comfortable writing cyber? Well, your clients may be asking you, your customers may be asking you for this cover because they're afraid of it too. In fact, I may ask my home insurer in America, American family, to provide this cover for me in case something gets hacked in my house. So how do you provide it? Is it growing? Well, it is. This is one of the things about cyber. It's one of the coverage areas that's actually growing. One of the things with the insurance market, especially in Europe, is that premiums haven't really grown for a very long time if you look at everything in aggregate. Cyber is an area of growth, and these are just some estimates. The estimates were made in 2015. The current estimate for the size of the cyber market is about $6 billion of premium. Okay, so it's not very big. Allianz has the most aggressive growth estimate. AGCS said in one of their publications that they thought that by 2025 we could get to 20 billion of premiums. And it looks like a crazy estimate, right? Unless we have a cyber attack or an event. Think about 9/11 and what that did to the terror market. Think about Katrina and what that did to the property cat market. Think about the mortgage crisis and what it did to the mortgage insurance market, right? If we have an event, I think that the Allianz estimate could be the closest one, at least if we're talking about 2025 or 2030. So it's an area of growth, and if you want to participate in this growth, you have to understand it. Now, part of being a good insurer is knowing when not to grow, or at least knowing how to grow. So I'll talk you through that if I can. But let me just tell you guys, you're probably all sitting up there saying, this guy is just a broker, he doesn't actually know how to underwrite, and you're right. I'm not an underwriter. Many of you are better underwriters than I will ever be. My role here is just simply to give you data that we have and information that you can use to make your decision and to form your strategy. But it's no good not having a strategy around cyber these days. So again, there are too many words on this particular slide, and I'm sorry about that, but I'll leave it for you to read afterwards. I think that there are three reasons, again, why the market is growing. Number one is that there have been a lot of high-profile losses. There are continuing cyber losses every single day, not just the big ones, but they're happening every day. Some of them are high profile. That creates a need where customers come to you and say, oh my gosh, how can I protect myself from this? And that is the insurer's conundrum, right? That's why we're in business, to protect people against risk and hopefully make some money doing it. So it's a question we have to answer. There's greater regulatory scrutiny. A lot of, as it says here, around 90% of all cyber products bought globally are thought to be purchased by American companies, due in large part to existing data protection regulations in the United States. If you lose my data, I will sue you. I will sue you and take you for everything you have. Welcome to America. That's the way we are. And so naturally, cyber insurance is really quite prevalent in America because, as you say, it came out of the E&O market from probably people in California, that's where I'm from, where we sue each other more than any other place in the world except for maybe New South Wales, Australia. So that's part of the reason why cyber cover is at the moment fairly prevalent in America. But actually, when you get beyond the litigiousness of America, there is a functional and a practical need for cyber risk as well. And there has been an increased supply of cyber insurance capacity and just general insurance capacity. And those of you who know me know that I can talk about this like for hours. We have more capital in the insurance market than we need right now. Just in the reinsurance market, we have $340 billion of capital on $265 billion of premium. There's too much supply, not enough demand in the reinsurance market. That's why prices haven't gone up. People want to find new lines of business. This is a new line of business. Doesn't mean you should write it, but it does mean that there is capacity, there is supply. Okay, so I just wanted to show you these two charts really fast. Okay, so just watch. See this? This is showing you where cyber coverage can reside. Cyber coverage can be standalone. It can fit into your E&O policy. It can be cyber terror. There's property cyber risk, believe it or not, general liability risk, special crime, and even bond, credit and surety risk. So where does the cyber policy reside? Is it in the standalone cyber market, or is it part of something else? And as Michael was saying, a lot of times, this might be silent cyber, right? You might be part of your property policy or your general liability policy, but it's actually a cyber risk. You have to model that part of the policy using a cyber model. You can't just use a general liability model anymore, right? Okay, so how do you do this? Well, listen, folks, nobody knows. Nobody actually knows. And I don't know, but this is a framework. This is a framework that you can start with. And I'm going to give you I'm going to show you what we've been doing. I'm going to show you what people in the industry have been doing, but it's the brilliant minds in this room, the underwriters in this room, who are really going to figure it out. I'm just giving you information. At a bare minimum, a policy should have net limits. I mean, this is just basic stuff, right? Inception and expiry dates, policy premium allocations, loss experience, waiting periods, deductibles. You should know the size of the organization and its revenue, the industry sector. But nice to have are things like, and this is where we're starting to get a little bit geeky, okay? Domain name, right? Country and location footprint. That sounds simple, but when you're talking about the internet, your footprint could be a lot broader than you think. Employee headcount, where are your employees? How many data records do you have? How do you back up your data? Do you do it in the cloud? Do you do it regularly? Frequency? Who's your parent? How much of your revenue comes from the internet? Have you asked yourself this? I'll bet a lot of you work for companies that have websites, right? How much of your revenue is tied to the internet? What's the value of BI per hour? What are the retroactive dates? And then the really important things that a lot of people don't capture at the moment are network assessments. What does your network look like? Do you know how secure it is? I bet you do. Physical and system security, data segregation, data portability, remote access prevalence. These are all big words. Risk management procedures, cyber ERM, if you will, vendor management procedures. How many people here employ people in the technology sector? How many of people here pay companies that are technology companies? How secure are they? Have you ever tried to assess this? Have your clients tried to assess this? Do you know whether the people you're insuring are exposed to external third-party vendors and could be liable? This is the sort of stuff that you have to look in. What are the regulatory and legal policies where you're underwriting? In the EU, we have GDPR, so there's that. Healthcare data compliance. Sorry to keep picking on the NHS, but they got pretty heavily nailed. Multimedia practices. Has there been any testing? Those are some questions to ask about cyber if you're underwriting it. Okay, part 3, the sausage, making the sausage, and then we're done. If you're going to do this, if you're going to underwrite cyber risk, you ought to have a team of people from different backgrounds who can do different things. Yes, you need actuaries. Why do you need actuaries? Because they're smart, they can do maths. Preferably your actuaries are actuarial programmers, and they can cross over and do stochastic modeling. Okay, and also I would say program. So that's going to become apparent in a minute. Cat modelers can be important for exposure management and also tail-side risk analysis. Strategic advisory, people that understand regulatory capital, rating agency capital, how losses affect the value of your franchise. It doesn't hurt to have somebody who knows terror risk, because a lot of cyber attacks are actually driven by governments, believe it or not. And it's good to understand, you know, the crossover between cyber terror and just regular cyber, and the tools that are developed in the terror market can be pretty relevant to cyber. And then information security people. I'm not talking about the people that work for corporate IT. I'm talking about people who can hack, people who know how to break into systems, people who know how to basically undermine security. You want to be able to do testing, and to do that you have to have people who know how to do this. Find a teenager, you know, they can do this. Find somebody who's, I would say, a digital native. Okay, so that's the dream team, if you can create it. And every broker tries to create this. All of us, whether it's Aon, Willis, Guy Carpenter, or JLT, formerly JLT, we all have teams like this. And if you're going to get heavily into the business, you should at least be advised by a team like this. Oh, sorry, these animations. Okay. After September 11th, I had the good fortune to be involved with somebody who was on the 9/11 Commission, Jamie Gorelick. I know that this all ended badly, and I'm sorry for that. But one of the things that we did very early on in the early 2000s was we tried to figure out how the hell are we going to stop this from ever happening again. Is it really those guys in airport security that are going to keep us safe? God, no, they're not keeping us safe. Let me just promise you that right now. But what they are is they're one tiny line of defense among many that you don't see. So the strategy that was really utilized by the US government and by European and everything after 9/11 wasn't just let's beef up the, airport security when you're checking your bag. It was a number of different things where they layered things. They had 4 or 5 different layers. Yes, we're going to have enhanced security procedures when you go into the airport, but there's also a lot of things that are going off away from security. For example, there's bag screening happening in the airplanes themselves. There are different methods of air traffic control, believe it or not, happening. And then there's external screening happening outside of the airport, and there are intelligence services involved. And what the hope was that if you know how the law of exponents works, or the law of logarithms works, the more layers of security you add, the harder it is for somebody to penetrate all of those layers of security. And that was kind of the philosophy. And it hasn't worked perfectly, but it surprises me sometimes that we haven't had another big terror attack on the scale of 9/11, knock on wood, right? But the reason for it is that there are 5 or 6 different layers of security happening that you don't always see, and that might be what's keeping us safe. Anyway, you have to do the same thing if you're going to underwrite cyber risk. You can't just have one smart guy in a room building a model. That's really important, and you should build, and I'll show you in a second. It's important to have an aggregation model. It's stochastic. You can run RDS, realistic disaster scenarios. You can quantify and qualify different types of events. But it's also important to analyze all the different vendor models and utilize the best of them, and I'll show you those. It's also important to look at what's happening in the direct market if you're a reinsurer, and in the reinsurance market if you're a direct insurer. And then it really would be good to have your own proprietary data set specifically for the clients that you're underwriting, and do your own analysis. Those are just a few of the layers that you can undertake as you go through this. All right. So this is just a diagram of, actually, it used to be JLT's, now it's Guy Carpenter's. I keep saying that, it's tripping me out too, because because everybody know we just got bought a week and a half ago. Yeah, JLT Re just got bought by Guy Carpenter, so it's awkward for me. I'm going to slip up at some point and characterize this as JLT Re's model, but it's actually Carpenter's. And we have developed a bottom-up tool. This tool was developed by our cyber risk team in London with Jamie Pocock, brilliant young man, actuarial programmer, geek, nerd. He always he programs at night in his spare time, and he and his team have developed this model. Basically, it's a bottom-up model with a focus on business interruption, including commercial business interruption dependencies and insurance exposure. The first thing he does is he calibrates the events independently. So he looks at different industries and looks at the types of service dependence in those industries, and then the impact severity and the likelihood of an event. And where, depending on what industry you're in, he can come up with a pretty good event calibration or series of events that could affect you. And then he basically takes that information and takes it from your company and starts to simulate different types of exposures in a deterministic fashion. Initially, it has to be said. From that, he gets impact vulnerability calibrations and impact severity calibrations, so he can look at your vulnerability and your severity. We don't have frequency data in the cyber market. In spite of all those examples that I gave you, we actually, it's not like the cat market where we have, 300 years of hurricanes in Florida that we can analyze, going back to the Spanish Empire. We don't have anything like that. All we have is, some anecdotal things. So we have to look at vulnerability versus severity, and then we can use that to create a stochastic model and come out with a results distribution. We are trying to create this so that it's like a clear box that you can look, not a black box. And that's meta-risk branding from Guy Carpenter. I had to try hard to do that. But anyway, it's a clear box that you can look in and modify yourself. Never make a model that's so complicated that only one person knows how to use it. So this is an example of an accumulation model, okay? A stochastic model built by an actuarial programmer that can come up with deterministic and stochastic scenarios. You should also look at the vendors, and I see we have some people here from RMS, so please just shout at me if I get this wrong. Last April, just incidentally, we published a report. We thought RMS was going to probably sue us because we basically came out and said, here are all the deficiencies with the CAT models, RMS, AIR, and EQE. Here's how they get it wrong empirically. And actually, you were really very nice to us, and you actually helped us with that report, and it worked out really well. So that's what we're going to do now. You need to look at all the different vendor offerings that are out there, and here are some of them. These are some of the things that they do. So in risk, I'm not going to name them all, but you can see them up here. There are companies that just model risk on an aggregate or industry basis, and these are they. There are also those that can model accumulation, and of course, some of these are insurance companies like Munich Re, and there's also Envelop Re, which is MS Amlin, Mr. Jonathan Spry doing that, and they're modeling accumulation. And then they can do that specific to your firm using firmographic data, breach data, and claims data. So these are some of the different things that some of the different vendors do. And you really should look very closely at all of them if you're going to underwrite cyber risk, because, love them or hate them, they've done a lot of work on this, and you have to be able to assess how good they are. So, sorry, these are just graphics. Forgive me. What this is saying, sorry, I should go back. Everything can ultimately contribute to your accumulation modeling, right? Okay, so science. Has anyone met Arvind, the guy who runs science? He sold it to Guidewire. Okay, CyberCube, Corax, Cover, RMS, AIR, Lloyd's. I will not read through all of this text because it would be torture for both of us. But you must become familiar, if you want to underwrite this, with the expertise and capabilities of these at a minimum, with the possible exception of Lloyd's if you're competing with Lloyd's. But in any case, these are the different things. I've tried to make a list of pros and cons for all, and I'll make this available to you afterwards if you're interested in having it. I think it's a pretty good list. We've tried to get it right. But please feel free, even if you're not from RMS, feel free to call me up and argue with me about it, because that's the way we assess these things over the long term. There was an attempt to assess the vendor models, actually. It was an inaugural comparison of 5 vendor models, RMS, CyberCube, Science, Corax, and Cover. The first time such an event had taken place, it was at the CAT Risk Management Conference in London in March 2019. Each vendor was given a consistent portfolio of approximately 50 organizations with standard insurance policy information to model. AAL and AEP curves were shared on an anonymous basis. So before we announced the winner, data were a significant issue. Revenue figures were different for some of the vendors, which wasn't controlled for in the outputs. And there was a pretty significant deviation across the board with average annual loss and average exceedance probability curves. But even in light of the general variation, there was one significant outlier, and it was CyberCube. They were pretty good, actually. So they've been making a lot of headway in the market. It turns out that both Guy Carpenter and JLT re-licensed CyberCube, so that's one of the vendor models, in addition to RMS and actually CoreX and some others that we use. Science is another one that's used by brokers, but who cares what brokers think? You should figure it out for yourself. Try to understand which one is best for your business. Okay, so in terms of the optimal approach for full cyber account modeling, you have to have event modeling. You have to be able to model large risk losses using a blend of experience and exposure, right? But maybe you can't do experience, so you have to do deterministic vulnerability, especially if you have if you're writing Romanian cyber Nicoleta, how many big Romanian cyber peak losses have there really been? You have to model vulnerability instead of experience. You can undertake your own additional modeling, looking at risk correlations. Stochastic, this I think is something that needs to be done once you've formed the accumulation model stochastically, and then you can simulate a gross loss table like this, and you can create underwriting distributions. Okay, now this will look familiar to those of you who underwrite and who undertake CAP modeling. Why is it important? Because with this, you can begin to create structures. Okay, and this is an example of a cyber structure that we pitched to a client at JLT, where we said to them, this is based on everything that we've undertaken, this is what your gross cyber loss probabilities are. Here's structure current, immediately to the right. Here's option A and option B. And the dots, sorry to keep touching the screen, it's probably giving you guys the heebie-jeebies with the waving around. But the dots are your expected profit, and then you can create different return periods based on the different structures if you've modeled something. Okay, so at this point you might be asking yourselves, wait a minute, how do you really know that any of this is really any good? You're talking about deterministic exposure, and deterministic loss probabilities instead of experience. You're talking about different ways to quantify exposure that seem pretty untested. And you're right, folks, you're right. There must be a big standard error. I'm going to say it right now. There must be a big standard error in these numbers, bigger than what we see in CAP models, I think, at the moment, to be sure. There's definitely a bigger standard error in this type of modeling than there would, even though these modeling companies are very sophisticated and very good at what they do. I think it's just important to realize that if you're talking about Romanian earthquake or European wind or Italian quake or Florida wind, and you're talking about tail risk, you have a slightly better understanding of it right now than you do of cyber. That's just reality. It's just the nature of the beast. It doesn't mean, though, that we can't create loss distributions and structures, and we have to start somewhere. And this is the standalone cyber market we're talking about, by the way, not the silent cyber that we will talk about in a moment. Okay, so this is stating the obvious. You're giving up earnings to buy reinsurance and lower your risk. And lower your volatility. Oh gosh. And stabilize earnings. And increase valuation. Oh, okay. I should really get ahead of these animations. I'm sorry. This really is showing how the sausages are made using risk parameters and a CVA model, creating cover. You've got the number of records, the industry, the type of company, the number of employees. These are some of the things that we talked about earlier, remember? The revenue, and then security level. This could be, for example, your science, and that's one of the vendors, risk score, PCI data, yes or no, breach response plan, yes or no. These are some underwriting criteria or risk parameters. The main factors used to estimate, make the frequency parameter, and remember, frequency is basically deterministic in a cyber model at this point. But you can look at revenue, type of company, interaction of the sector and revenue factors, the interaction of the type of company and different revenue factors. Once the putative frequency, I will say the deterministic frequency or vulnerability has been estimated, there are other factors like security level and other things. And then you have other factors affecting severity. The primary factor affecting severity is just the number, the potential of, the breach potential, the number of records which could be breached. And that can be adjusted based on the number of records usually breached at a cyber loss on average, e.g. 9% of the time, 90 to 100% of records are breached. These are assumptions. You can see, like, these are just qualitative assumptions that you're making based on data that you're getting from vendor models. So this is where the underwriting takes place. And then based on that, you can create limits and retentions in different programs. You know this, but I'm trying to point out that there's still a great degree of uncertainty in the process. And then last but not least, silent cyber. You know, you can explicitly exclude cyber from your policies if you want to eliminate cyber. You can affirmatively cover cyber, preferably in a standalone policy, or the policies are effectively silent, meaning that they're part of your E&O policy, they're part of your construction cover, believe it or not, they're part of terror, they're part of your war policy, they're part of your trade credit policy. And there, the challenges are, where are the goalposts? What does the wording say? Does this cover cyber or doesn't it? That's why we, in the broking community, are big advocates of creating a standalone market for cyber, but then of course there's a cost associated with that as well, at least up front. The back-end cost, as somebody mentioned earlier, I think it might have been our friend from Spain, said it's better to take care of these things up front while you can. So, you know, again, the possible approaches to quantification are the same as they are in the standalone market. By mid-2019, we will be developing basically a database of systemic silent cyber risks accumulating across different classes and insured entities. We're going to use a really big event set and try to assess internally for our clients where the silent cyber lies by industry and by loss class, and then set up an intuitive calculation framework. We're going to be doing planned scenario dimensions by class and subclass, by industry splits, scale, and locality. And if you look at, this is kind of a spider graph showing you where the silent cyber overlaps with other types of policies, and a heat map. And I'm sorry, none of you can read this, so I won't try to explain it, but it's basically showing you the different classes of business that have the highest probability of silent cyber risk. And there will be example scenarios that we'll publish. Financial exchange attack. What does a financial exchange attack do to your silent cyber risk in different scenarios? Same thing with a midstream energy infrastructure targeting national power grid outage, telecom network manipulation, and a manufacturing supply chain interruption. How does this affect you? At least in these hypothetical scenarios. So that's it.